Hello and welcome. In this month's on-demand webinar, OJM Group Principal Carole Foos, CPA, presents an overview of the Tax Cuts and Jobs Act, which was signed into law at the end of 2017. She discusses key provisions affecting individuals and businesses and offers advice to consider when planning for 2018 and beyond. It's important to note that this video is for informational purposes only, and the information may not be suitable for your personal circumstances. Please contact a professional before attempting to execute any of these strategies. If you find this information helpful, we would encourage you to check out one of our books. OJM is pleased to announce the publication of our newest book, Wealth Management Made Simple. The authors provide answers to common questions they have heard from their work with OJM clients. Topics include investment terminology, market history, tips for choosing an advisor, and more. At the end of the webinar, we'll discuss how you can get a free ebook download or hard copy of Wealth Management Made Simple or any of our other books.
The first thing we want to cover today are the individual provisions in the new Tax Act. So first and foremost are the new tax brackets. These will be effective starting January 1st, 2018 and will expire at the end of 2025. As you can see on the screen, for single taxpayers, the highest rate of 37% goes into effect at taxable income above $500,000. For married individuals filing jointly, that 37% rate comes into play at taxable income over $600,000. There are still 7 tax brackets that will affect you. It's still a graduated rate system. So those will be important to note going forward in your planning. Other provisions included that will affect your individual taxes include a simplification of the kiddie tax. So what's going to happen now is that trust and estate rates will be applied to unearned income of children as opposed to them being taxed at their parents' taxable rate. To some extent, this will make it easier. You can file your children's return prior to your return being completed. You don't have to have all the siblings' returns finished in order to calculate that kiddie tax. However, it is going to be an increased rate as that top tax rate for trust and estate goes into effect at just over $11,000 of taxable income. The standard deduction was increased under the new Tax Act from $13,000 to $24,000 for joint filers, and it went up to $12,000 for single taxpayers. So this was meant to offset some of the other things that went away in terms of itemized deductions, and also because the deduction for the personal and dependency exemptions were eliminated. Alternative minimum tax was not repealed for individuals, but the exemption amounts were increased up to $70,300 for single taxpayers and $109,400 for married taxpayers. And that exemption phase out now does not begin until $500,000 for single taxpayers and $1 million for married taxpayers. Capital gains and qualified dividend rates did remain unchanged, and new under this Tax Act, also in terms of 529 plan contributions, you can now take up to $10,000 per year per student and use it for elementary and secondary school. Previously, 529 contributions could only be used for higher education expenses. Lots of changes came into play on itemized deductions for individuals. I think one of the more widely reported on changes is that the deduction for state and local income, sales, and property taxes will now be capped at $10,000 for both married and single taxpayers and at $5,000 for heads of household. So this will have a big effect for those of you who live in states with high income and property taxes. In addition to that, most miscellaneous itemized deductions have been eliminated. This includes tax preparation fees, investment fees, so those are now gone. Good news on the itemized deduction front, the PEAS limitations go away. So if you recall, the PEAS limitations actually reduced itemized deductions for higher income taxpayers, and you lost some of those. Now you'll get to deduct the full amount of those itemized deductions, even though some of them have gone away. The medical expense deduction floor has been reduced from 10% to 7.5% for 2017 and 2018. Other big news that has been widely reported is that for mortgages that begin after December 16th, 2017, interest is deductible for a principal residence and a second residence on loan principal of $750,000 in total. Now, for mortgages that started before that December 16th date, you could deduct interest on loans of up to $1 million for acquisition financing, plus up to $100,000 of home equity financing. Interest on home equity loans will no longer be deductible at all. Do keep in mind, if you refinance one of those mortgages that you had prior to December 16th, 2017, the refinancing can still be grandfathered as long as you're not extending either the term or the amount of that original mortgage. So you'd still get the $1 million cap versus the $750,000 cap. The charitable contribution deduction has gone up from the 50% of AGI limit up to 60% for contributions to public charities. However, the charitable deduction has been eliminated for contributions made in exchange for college athletic event seating rights. So whereas seat license donations used to be 80% deductible, those will no longer be deductible. The child tax credit has increased to $2,000 per child, and $1,400 of that amount will be refundable. The individual mandate, which requires most Americans to purchase health insurance under the Affordable Care Act or to pay a penalty, will be revealed, but that is not effective until 2019. Other things to note would include that the exclusion for reimbursement of moving expenses has been repealed. So if you're moving for your job and your employer reimburses those expenses, that will now be income includable in your W-2. There was also a big change in the alimony rules. So alimony paid effective for divorce agreements that go into place after December 31st, 2018 will no longer be deductible. It also won't be taxable, the alimony income, to the recipient, again, for divorce agreements after December 31st, 2018. If you have a divorce agreement in place before that time, it's still going to fall under the old rules. Business provisions had certainly some of the bigger changes, and the business provisions are permanent. They don't expire like the individual provisions do. So big thing is for C corporations, there's now a 21% flat corporate tax rate for corporation tax years beginning after December 31st, 2017. If you recall previously, the top corporate tax rate for C corporations was 35%. The alternative minimum tax has been repealed for corporations. There's also now an immediate 100% expensing for the purchase of business equipment if that equipment is placed in service after September 27th, 2017 and before January 1st, 2023. The depreciation cap on luxury autos has been increased. The limitation for Section 179 expensing has been set at $1 million. Under net interest expenses, the deduction for interest expenses will be capped at 30% of adjusted taxable income. And also, net operating losses will be limited to 80% of taxable income. A portion of subsidiary earnings and profits held overseas will be taxed at a reduced 15.5% rate for cash assets and 8% for illiquid assets. So this is that repatriation tax that's been talked about a lot. Section 1031 like-kind exchanges will now be limited to real property, so no personal property exchanges will be allowed under this section of the code. Also, a big change will be that the deduction for any activity deemed to be entertainment, amusement, or recreation, including club membership dues, has now been repealed. So no deduction for entertainment expenses. Pass-through business income probably has some of the biggest changes as well as some of the most complicated changes under this new tax act. So there will be a 20% deduction against qualified business income of pass-through entities. That includes S corporations, partnerships, and sole proprietorships. But that deduction will be the lesser of 20% of the qualified business income or the greater of 50% of W-2 wages paid with respect to the business, or the sum of 25% of the W-2 wages paid plus 2.5% of unadjusted basis of all qualified property. The deduction is further limited to the net of taxpayers' taxable income less net capital gain. So let's just take a minute and think about this. And first I'll say that wage limitation does not apply at all if you're a married taxpayer and your taxable income is under $315,000, or if you're single and your taxable income is under $157,500. If you're in that situation, you get to deduct 20% of your qualified business income. If you're not, if you're above those limits, then you also have to look at what is my allocable share of W-2 wages that are paid by my pass-through entity. And I can only take that 20% deduction up to the amount of 50% of those wages. If I'm a business such as a real estate business where I probably don't pay out any W-2 wages, then that 20% of my qualified business income would be limited to 25% of my share of the W-2 wages plus 2.5% of the unadjusted basis of my property in the business. So it's complicated. It definitely makes sense for you to talk to your personal CPA about how it's going to affect you. And also keep in mind specified service businesses such as accountants, attorneys, and doctors are excluded from this deduction unless you fall under that taxable income limit of $315,000 married or $157,500 for single taxpayers. So again, definitely makes sense to talk to your CPA about how this pass-through deduction will affect you. For estate taxes, the estate tax exemption and gift tax exemption are generally doubled from $5 million per individual up to $10 million per individuals, and that's indexed for inflation that occurred after 2011. This increase in the exemption is effective for anyone dying after December 31st, 2017 and before January 1st, 2026. So for 2018, that indexed for inflation amount for an individual will be $11.2 million. Some things for you to consider in terms of this new tax act. Again, most individual provisions are temporary and expire after 2025. This might mean for you it's a great time to fund your Roth, and it's a great time to fund after-tax non-qualified plans. So put that after-tax money in now while tax rates are lower. Go back to funding those pre-tax buckets in greater amounts after these expire. Also, it makes a lot of sense to evaluate your choice of business entity. With a new C corporation rate of 21% and the new qualified business income deduction for pass-through entities, you really need to sit down with your accountant and think about what makes the most sense for you in terms of a business entity. We talk to our clients a lot about tax diversification, as you see on the screen. 3 different ways your income will be taxed now and in retirement. So those assets you have in a qualified plan, like your 401k, would be in the green bucket. And when rates go back up after 2025, you may be looking at a 50% tax rate between federal, state taxes, and Medicare tax. Over in the blue bucket, where you're talking about Roth IRAs, cash value life insurance, municipal bonds, that's your tax-free bucket with a 0% rate. So again, you want to have money in each of these buckets in retirement. You've got your orange bucket with real estate, brokerage accounts, et cetera, that are taxed typically at qualified dividend and capital gains rates. So be filling up all these buckets. Times when tax rates are lower are a great time to fill up that blue bucket, as well as continuing to fill up the green and the orange. We appreciate your listening, and we look forward to speaking to you soon.
OJM is a multidisciplinary wealth management firm, and we have worked with over 1,000 clients throughout the country. We work in 3 different divisions for our clients: investment management, consulting, and insurance benefits. We would welcome the opportunity to speak with you about how we might be able to bring value to your wealth planning. As I mentioned at the beginning of the webinar, our principals have authored several books, all of which are available to webinar viewers at no charge. You can get a free hard copy or ebook download for Kindle or iPad by visiting ojmbookstore.com and entering the code OJMWEB at checkout. In addition to a free book, OJM Group also offers webinar viewers a complimentary consultation where we can answer your questions and see if our firm might be a good fit for your situation. Visit ojmgroup.com or call 877-656-4362 to schedule your free consultation. Enjoy the free copies of our books, and we hope to have the opportunity to speak with you. Thanks for watching.